And there you have it. The markets are officially closed on this Friday, September 13th. Welcome, investors and traders. I'm AJ Monte, and this is the weekly market report. We have a chart here of the Dow Jones Industrial Average ETF, ticker symbol DIA. It's a daily candle chart, and as I zoom in here, you can see that today's price action was very interesting because we gapped up, but then closed with a shadow above that candle, which tells us that towards the end of the day, the sellers came in. We generally see those long shadows at tops. And remember, last month, I did officially call a market top. I keep repeating the fact that I'm not calling a high, I'm calling a topping pattern. If I back out and take a look at the monthly chart, you'll know exactly what I'm talking about with regard to a top. You can see that here we are, the September candle, as I zoom in there, is very much a hanging man. Last month, we had a hanging man candle. You can see what a hanging man candle looks like. It's bearish most of the time. Back here, we had a hanging man candle. And again, 80% of the time, the markets will drop. So that top is still in force. And as I go back and look at the daily candle chart here, you can see that volume increased today, but we also have a long stretch of green. We have 3 green candles in a row. We're at a resistance point, but because of the increase in volume and the big Fed announcement next Wednesday, I do believe the institutions are going to try to push it to new highs prior to the pivot. We'll have to see whether or not the Fed cuts by 25 basis points or 50 basis points. We'll have to see. But next week on Monday, I will be putting out an article through ZeroHedge talking about the Fed pivot and what that could do to the dollar and to the precious metals markets. Just as a shout out to our traders, those who got into the PAAS position, you could see this pivoted nicely, hitting my target to the upside there at $20.38. And we went a little bit further than that, filling this gap right here. Now, the reason I show this to the general public is because the trade is already in. I'm not giving out any secrets that our members pay for, but that was a home run of a trade. Another home run of a trade was for our option traders as well, where last week we bought the November $41 calls for around $190. Some of our members got in at $2, and we hit that price target perfectly. Both price targets were upside targets that hit. Now we see the pivot. So hopefully our members had the opportunity to take that 100% profit on that trade. If you're interested in learning how we do this, just come on over to StickyTrades. We got that 15-day trial. That's an offer that is absolutely free. We don't take credit cards. We don't play any games with that. If you like it, you stay. If not, you come back to YouTube and watch my free videos. No feelings are hurt at all. So come on over to StickyTrades, try that out, plug yourself into some of our webinars, and you'll be able to sample that and mingle with our traders as well. So that's the 2 trades of the week, is PAS and URNM. I'll have some other great candidates next week. I'm already shopping for a few, and it's looking pretty good because the markets are following the technical signals like a charm. Going back to DIA, what do I think the forecast is going to be? I think we're going to go just a little bit higher, and then I think we're coming right back down to test the moving average. Ultimately, I'm going to put a line right here to draw that out sideways because I think that ultimately that target will hit once again. We have a downside target then there that I will match right there at $400.52. I'll adjust that line to make that exactly horizontal. But this is a 3-part forecast, by the way. Upside target next week is going to be 417.58. I think we'll see a drop in volume after the Fed announcement, and then I think we're going to come right back down to short-term target of 411.32, and then an intermediate downside target again down there at $400.52. So that's for DIA. Keep your eyes on my videos, because this is the evidence that most people need when building their confidence in the technical charts. These charts are absolutely amazing, and they are the best forecasting tool that you're going to find anywhere. Now, here we go. all of these downside targets have hit. See, here's a two-parter. Upside target hit, then the downside target hit, then I extended that downside target to 206.47. That hit. The intermediate target hit as well. Just take a look back and you see all these targets are hitting like a champ. And so we have an increase in volume on that green candle. Remember, I did say that we'd see a little bit of a pop. On Wednesday, I said that, and that's what's happened. I think we'll go a little bit higher and then come right back down to fill this gap that was left today. So that downside gap would be filled at 212.78. So I'm going to match this exactly to that target, 212.78. That's the gap fill target. 80% of the time, gaps fill. 80% of the time. Take that to the bank. If you don't believe me, go out and look at any chart, any market, any ETF, any currency, and take out a spreadsheet. Note the times that the market is gapped up or down, and then go back and analyze the number of times that those gaps have filled. And you will see with your own eyes that 80% of the gaps fill. So those gaps become beautiful price targets for the intermediate or short-term swing traders. And that is something that I'm giving to the general public as an FYI/educational value point right there. The gap fill targets are something that you can rely on. If you want to learn more about gaps, go down into the description box below, and I have some links there that talk more about gaps, role reversal, pivots, ABCD patterns, you name it. It's right there in the description box below. All right, so moving on to QQQ. Again, I said we could see a rally and possibly a break over that 20-period moving average. That's exactly what's happened. It's pretty much going to be the same story. I think just a tad higher on the Qs, which is the tech sector, and then right back down. I'm going to do a 50% Fibonacci retracement from this low to this high. Let me just draw that for you, and then I'll take it off. I do this by eye, but you can see very easily how I use my Fibonacci calculator. Take that low, drop it to this high, and what do we have? Very close to the 50% retracement level, which is this red line right here. I'm coming in a little bit shy to be conservative and hitting that target, and you could see that we use the Fibonacci retracements as a tool to evaluate the price targets. So that's, again, another thing that we have down there in the description box that you can learn about. So here is a three-part forecast. I'm going to say we're going to have, again, a continued drop in volume down below. That's telling us that the buyers are weakening. You could already see that the volume is dropping. I think we're going to go just a little bit lower. And then I think we're going to peel right back down below that moving average at 464.86. Again, shorter term downside target, then a longer term or intermediate downside target, still in place down there at 443.81. Why do I set those targets? Well, mainly because we have a lot of option traders that follow us, and those short term or intermediate price targets are very valuable for them when trying to determine which strike prices to trade or which spreads to put on. And we're having great success with our option trades for sure. So that is QQQ. Going on to SPY, take a look. Pretty much the same story. We have a rally, all this green. We got 5 green in a row, and then we have the drop in volume. This is going to be a little bit different. I think we're not going too much higher, so I'm setting a shorter term downside target on SPY at 555.58, 555.58. And here's why I'm not going too much higher or even forecasting higher on SPY. It all comes back to the VIX. You may have heard me talk about the VIX, saying that for the most part, it's inversely related to the S&P. And you can see that we are now in a downward short-term leg, but take a look. It's hard to see. I have to expand this a little bit. We're getting a slight little hinge in the CCI, which for me is the best leading indicator out there with regard to the oscillators. The CCI, the Commodity Channel Index, developed by Don Lambert in the 80s, one of the best tools. Keep in mind that while it's labeled the Commodity Channel Index, it can be applied to equities, currencies, mutual funds even. If you could pull up a chart on mutual fund, you could use that to track your prices there. And it's an excellent forecasting tool. It is much more sensitive than the stochastic, which is my secondary oscillating index that I use to confirm the signals as they change from being bullish to bearish and vice versa. Moving right along to some of the geopolitical and economic news, next Wednesday, the 18th, is a big day for the markets. We're going to finally find out whether or not the Fed is going to cut rates and how far they will be cutting rates. Again, I'll be writing more about that in the ZeroHedge article coming out Monday morning. And so these are the different scenarios that could play out. If the Fed comes in with a 25 basis point cut, those who believe it should have been 50 basis points might be disappointed, and it could sell the market off. On the other hand, 50% of the market is betting on a 50 basis point cut. Now, play this out. For those who are getting the 50 basis point cut, they might be happy. But those who were anticipating the 25 basis point might say, wait a minute, that's too much. That's going to bring back inflation. So there's a lot more or less teetering on this decision. And then, of course, if the Fed comes out and says, hey, the data is telling us we can't do anything with regard to rate cuts and we get a big zero there unchanged, then I think that's going to spook the markets much lower. So be prepared. This is going to be an interesting week coming up. And if you keep an eye on the charts, that's going to give you the signals, because we have an 82% hit rate on our targets. That is the best in the world. We have this all documented. It varies from month to month because every week I go through hundreds of stocks with our members and I analyze them, putting price targets on them. And in fact, as of last Wednesday, almost 27% of our targets are hit just from last Wednesday's rapid fire session. So that is very close to a record. Very rarely do you get that high of a percentage of hit rate within a couple of days of putting those targets out. But we're doing it here. We're teaching people how to do it. If you're a student and learning about technical analysis, then StickyTrades is the place to be. I love teaching people. You may hear that in my voice each and every week. I love doing this for you. Hopefully you'll learn it, pass it on forward to the people you care about most, and you'll stay connected. If you like what you see here today, please, I don't want to beg too hard here, but that definitely helps us if you like, share, and comment on the video. If you subscribe, that's even better, but commenting is a big deal because it helps drive the algorithm and get us on the main menu. So please continue to like, share, subscribe, hit the notification button, and I'll talk to you next week. So long.